In this screen recording, I'm going to talk about two things. First is equity risk premiums, and then the second is how I built a technology stock index fund that I'm going to hold for the next year and see what happens. All right, here we go. So first off, I want to talk about where I got the data, which is this website by Dr. D. He's a professor at NYU's Stern Business School, and he's great about putting his data online. He's very public on the web. This is his last Twitter post from yesterday, which sets the frame for equity risk premiums. And those are defined by Dr. D as anything that has a risk above something that you invest in that doesn't have a risk, which is a risk-free rate. So, for example, actually, I'm not going to give an example just for simplicity's sake. If you look at this chart, you can see it's a valuation of the S&P 500, and it shows that the equity risk premium of the S&P 500 is about 11.78%. So that's an indication that it's overvalued. Now, a lot's happened in the U.S. financial market in the last 12 months, and who knows what's going to happen in the next 12. So the ideal would be this, what Dr. D calls the Goldilocks market. And you can see that would be a situation where interest rates stay low, companies make money, and earnings per share start getting closer to a historical norm. And if this is the path the economy takes, we can see that the index will actually be undervalued. And then there's 6 other scenarios in this spreadsheet. So one is that the interest rates could stay low and companies may not make very much money. The economy could sink, and in that case the index will be overvalued. There's almost a 40% spread between those first two categories. There could be a reality check where interest rates raise slowly on one side, but earnings don't meet expectations. So if we look at this second row, we can see that there's there's a smaller range here. It's still large though. Instead of over 40%, we're closer to 30, actually 26%. And then the last one is the rate shock market. If interest rates rise quickly and there's a meltdown, you can see if you do 13 minus 40, that puts you at about 27% range. So those are some scenarios we have going into 2021. And when we look back on 2020, the people who did the best in the market are the folks who invested in two industry groups. One is technology, and then the other one would be banks and financial institutions. They made that. If you look at the data sets on Dr. D's website, it's very clear that those companies did the best. The people who did the worst in 2020 were the ones who got out of the market completely when it crashed in March and held their money in cash. Those people lost big time. So it just all goes back to how much risk you're willing to take. So what I did with this activity is I took a category from one of the data sets on Dr. D's sites, and this one is the category that had the second most growth in 2020, and it was the computer peripherals category. So we can see that I pasted all the companies into this Google sheet. And what's nice is using the Google Finance API, we can pull current price data, which is the risk premium, and what people are willing to buy is what is the risk they're willing to take on a company. And we got a 52-week low, as well as a current rally calculation. So we can see, and then conditional formatted in column G, so we can see which companies in real time have done the best in the last year. And on the company that's done the best is up here, grew 600%, and the company that did the worst is down here, grew 27%. Now, just a little asterisk, there were about 28 companies that just didn't have good data. They are on public exchanges, and their stock didn't really move very much, and it's all, some of these are less than their stock's valued at less than a fraction of a cent. So I just took them out of the data set for simplicity's sake. Their stock is valued too low to be useful for investing, even though it's included in macro data sets that Dr. D posts. So then the next thing I did was I looked at what my budget for this project was, which is about $1,000. I'm willing to spend $1,000 investing a little bit in each one of these companies, knowing that if they all go bankrupt, I'm okay losing that amount of money. So that's my theoretical loss. And the next thing I did was I started, it took me a couple days to do this, but with my brokerage, it actually didn't cost me money for to complete these transactions, because I'm with Charles Schwab and they don't charge you for that anymore, which is great. And so I slowly bought a little bit of all these companies. So for the most part, they're fairly evenly weighted, except for the bigger companies that are traded higher, and I'm happy spending a little more money on those companies like Dell, buying one share for 80, or Apple was actually the most expensive, which was there we go, 132 when I purchased it. But the rest of these I just kind of for the most part kept my investment in the $20 range. So that's what I did. It's pretty exciting for me anyway. Those are my Thursday musing on markets, and we'll see what happens. Let me know what you think. Thanks for watching. Bye.